It's me again, Cal, your personal pocket-sized lawyer, and today I'm going to help you all in saving some of your hard-earned money. Did you know that your tax bill is the single largest expense you'll ever likely pay in your lifetime? And with the recent tax changes that are coming into effect this year, that's probably not going to change. You probably also didn't know that billions of pounds of extra tax overpayments are paid to the government cumulatively each year. There has never been a more important time for people to acquire some basic knowledge on tax and minimize their tax bills. Intelligent people understand the need to invest in knowledge on tax, but that's why I've spent the last few days creating this video for you today. So in part one, I will explain very simply the important new tax changes in 2025, and in part two, we'll be looking at the most effective strategies, allowances, and legal loopholes for you to take advantage of. And believe it or not, I'm going to do all that in just under 9 minutes, so grab yourself a drink, hit that subscribe button, and let's get to work. Right, let's kick off with what's changing in 2025. Here are the key updates that you need to know following Labour's new tax proposals. Number one, the personal allowance freeze. That's the amount of income you can earn each year tax-free is staying frozen at £12,570 until 2028. That means no increases in line to offset inflation. So if you're going to be getting paid more this year, or you're going to get a pay rise, then more of your income stays in the higher tax bracket, unfortunately. Number two, the high rate tax threshold is also being frozen at £50,270. So if you're earning above that amount, you'll be paying 40% on income over that threshold. Again, with inflation pushing wages up and people earning more money, more people are going to get dragged into this higher band. Number three, the capital gains tax allowance cut. So for 2025, the tax-free allowance on capital gains is dropping to just £3,000 down from £6,000 in 2024. So bad news for anyone selling property. They also increased the capital gains tax rate on shares from 10 to 18%, which basically means bad news for anyone thinking about selling shares this year. Number four is also the dividend allowance cut, which basically means the tax-free dividend allowance is shrinking to just £500. So if you own shares in a company, if you're self-employed and you pay yourself in dividends, then this is going to sting. Number five, pensions and inheritance. So one of the biggest changes that was announced in the budget was the intention that most pensions will now fall into the inheritance tax regime from April 2027, which at the moment are usually passed on tax-free. We'll go into what that means and what you can do about this later. So basically, to sum up, less income tax allowance proportionate to inflation, less capital gains tax allowance, less dividends allowance, and on top of that, stricter inheritance taxes. There has never been a more important time to learn some tax minimization strategies. Now, your first strategy must be to max out your ISA allowance, your individual savings accounts. Now, these remain one of the most effective tools for tax-free growth and income in the UK. Each year, individuals like yourself can contribute £20,000 into an ISA, and all returns, whether from interest or dividends or capital gains, are all entirely tax-free. In addition, any profits made within an ISA are exempt from capital gains tax. Dividends or interest generated by investments in an ISA, like a stocks and shares ISA, for example, are not subject to income tax. In 2025, the ISA allowance remains at £20,000. It's not changed, but if you're not using this allowance, you are leaving money on the table. Here is the strategy you need to take. Number one, obviously utilize your cash ISA's £20,000 allowance. Great for risk-free savings. The interest rates are finally starting to climb, so it's worth a look. I recommend a lifetime ISA, or a LISA in short. Now, these savings accounts allow you to put £4,000 into them annually, and in return, it gives you a 25% cashback bonus for free. Meaning, if you save the full £4,000 a year into this account, you'll be given an additional £1,000 tax-free at the end of that year. And that's on top of any interest that you earn on it. That is huge. The lifetime ISA is an absolute no-brainer if you have savings just sitting in your bank account. Now, the second action to take is if you have any taxable investments, if you do transfer them to a stocks and shares ISA, ideal if you're investing for the long term. My personal recommendation for a stocks and shares ISA is with Trading 212, which is a firm that allows you to buy shares and invest in funds with no commission, but there are many other companies like this out there who offer this same service. And your third action point is to utilize your junior ISA. So if you've got kids, you can stash away up to £9,000 per child per year into a junior ISA. Again, all completely tax-free. And there's another great tax advantage of this. With junior ISAs, families can put money away over time for their children and for their grandchildren without needing to pay inheritance tax on it. A huge chunk of your estate can be protected from the tax man this way. This strategy is just a no-brainer. Use your ISA allowance, before your tax year ends. Strategy number 2 then is pension contributions. Now look, I know pensions aren't exactly the most exciting strategy, but they are a tax saving powerhouse. Contributions to your pensions are tax-free up to certain limits, and in 2025 the annual allowance is a really generous £60,000. Now here's why this matters. Number 1, obviously tax relief. So when you contribute to your pension, the government gives you tax relief. So if you're a basic rate taxpayer, every £80 you put in gets topped up to £100, for example. For higher rate taxpayers, it's even better. You can claim back 40% or even 45% through your tax return. Now, pension growth is tax-free, providing a significant compounding advantage over time. You can also withdraw up to 25% of your pension pot tax-free immediately upon retirement. Second benefit is employee benefits. So if you are employed, your employer may offer a matching scheme. So make sure to check that, and also make sure that you're contributing enough to that scheme to make sure you get the full match. That is essentially free money, guys. Now let's look at strategy 3. So if you are married or in a civil partnership, here are a few game-changing strategies for you to take advantage of. The first is spousal income splitting, and here is how it works. If one partner is in a lower tax bracket than you, you can shift some income or assets to them in order to reduce your overall combined tax bill. For example, transferring savings or investments so that the higher earning partner pays less tax on the income that they are generating. This has always been a great hack, and every married couple should be doing this where possible. Now, the next benefit of being married is to use something called your marriage allowance. This is such a simple but useful tip. Now take a look at the graphic on screen to help you. What this means is that you can transfer up to 10% of your personal income tax allowance to your spouse or civil partner. Remember, your personal income tax allowance is your first £12,570 of income. This means you'll be able to transfer £1,260 of unused allowance to the higher earning partner each year, saving up to £252 each year. Of course, for this benefit, one of you must be earning below the personal allowance, which is common with non-working or child-caring parents. Now, it's a simple move, but it can save you a really tidy sum each year. Strategy number 4 then is to set up a corporate structure and claim expenses. Now, this next strategy is, in my opinion, the biggest tax saving mechanism for anyone who is self-employed or who can set up their own business and receive income. And that is to take advantage of the benefits of a corporate structure. So if you are able to set up and receive income through a limited liability company, you will have many tax advantages, including the attractive 19% corporation tax rate, and most importantly, the ability to claim business expenses. And look, this is by no means a new trick that many of you will already know, but here's a quick reminder of what can now be claimed by your company as business expenses and exempt from your final corporation tax bill. So number 1, home office expenses. So if you work from home, which is a lot of people now, you can claim a portion of your household costs. So this includes rent, electricity, heating, and even your broadband can be claimed as business expenses. HMRC offers a simplified flat rate method if you don't want to calculate the exact percentages, but working out the actual cost could actually save you more. You've also got travel costs, so the cost of using your car for business purposes. You can claim 45 pence per mile for the first 10,000 miles, I think, and then 25 pence per mile for after that. You've also got public transport like flights or accommodations related to work. These costs are also deductible, and office supplies and equipment, whether it's a laptop or a printer or even stationery, if it's for business use, it's a deductible expense. You've also obviously got client entertainment and marketing. So if you're wining and dining clients or spending money on advertising, these are valid business expenses and can be reduced from your overall tax bill. Just make sure to keep detailed records. HMRC is very strict about what counts as entertaining. Now, the golden rule here is to keep, like I say, keep detailed records and receipts for every expense. Now, quick one before we continue, guys. I will never at any point ask you to hit my subscribe button, only that you give me an opportunity to earn it from you with the content that I've made for you. So if at the end of this video you feel like you've liked or learned anything of value, please feel free to do so. Now, next strategy is super quick but super important. That's because it has recently been revealed that 1 in 6 people are overpaying on their tax returns because of incorrect tax codes. As a nation, £5.8 billion is apparently overpaid due to this error. So strategy number 5, check your tax code. Now your tax code indicates how much tax HMRC will collect from your salary, and you can find it on your payslip. So make sure to check your tax code each year or after changing jobs to make sure it's correct for your situation, because many people don't realize that they are on the wrong tax code and may be entitled to pay less tax in coming months or receive a refund for previous years. Now then, our next strategy, and an important one for anyone buying or selling assets this year, is a capital gains tax strategy. Now, if this does not concern you, then feel free to skip ahead using the timestamps below to the next strategy. But if you're planning on selling any assets this year, then listen closely. So very simply, your capital gains are the profits you make from selling certain investments, and your capital gains tax is a tax on the profits that you make when you sell those assets at increased value. So with the capital gains tax allowance dropping, like I said, from £6,000 to £3,000, managing your investments is now even more critical. So I'm going to teach you some asset disposal strategies to avoid unnecessary tax. Number 1, time your investments. So plan the sale of your investments or property in order to make full use of the £3,000 allowance each year. Number 2, offset losses. So if you've made losses on some investments, consider selling them in order to offset your gains elsewhere and reduce your tax bill. Losses are actually useful, so make sure to use them. And number 3, the bed and ISA strategy. So with this advanced strategy, you can sell investments to realize gains up to your allowance, £3,000, and then repurchase them later in the year from within an ISA, like I mentioned earlier, to protect future growth from tax. And number 4, you can use your partner's allowance. Remember, if you're married, you've got 2 allowances to play with. As spouses, you should transfer assets between you in order to maximize your allowance. Now, our next strategy is for anyone worried about inheritance tax and the lack of much needed reform, and this is called the gifting strategy. So in 2025, the inheritance tax nil rate band remains frozen at £325,000. For anyone who doesn't know what the nil rate band is, it's the amount of your estate which can be passed on to your beneficiaries free from inheritance tax after you die. So £325,000 of your estate can pass free of tax. Now, while this amount remains the same in 2025, effective use of exemptions and gifting can significantly reduce the taxable value of your estate when you die. So let's look at some key gifting strategies. Number 1 is your annual exemption. Everyone has an annual exemption where they can gift up to £3,000 of their estate away each year tax-free, with the option to carry forward unused allowances from the previous year. Now, you also have the minor small gifts exemption. This allows you to gift up to £250 per person per year tax-free from your estate. And finally, and most importantly, is a 7-year rule which you need to be taking advantage of. So larger gifts are subject to inheritance tax, as we know, unless they fall under the 7-year rule. So under this rule, you are able to avoid inheritance tax entirely on any large gifts so long as you survive 7 years after making that gift. And depending on how long you survive after making the gift, it dictates how much tax you spend on it. Okay, guys, I think that covers all the basic tax saving strategies that even the most novice investors can get their heads around. Remember though, tax is designed to be complex and daunting, and the government are incentivized in many ways to keep you in the dark about tax and keep you paying as much as legally possible. But you have to be proactive in protecting your wealth. Don't just sit on your hands by using tax efficient vehicles like ISAs, making the use of the many tax allowances available to married couples, and using a corporate structure to take advantage of the corporation tax rate and business expenses. You can preserve your wealth and achieve your financial goals. If you have any advice or tips of your own or suggestions that have worked for you and you'd like to share, post them in the comments below. I'd love to hear from you and I'll reply to as many as I can. And as usual, if you've liked or learned anything from the video, then subscribe and get notified, because I'd love to keep making educational videos for you guys. Thanks for watching, and I'll see you in the next video.